All right, good morning, everybody. This is take two of our weekend market outlook here from Market Scholars. This take one ended up being a corrupted file that I did actually before the market closed yesterday. Ended up taking a trip last night and seeing our local high school team here win a last to second buzzer beater three-pointer to win an overtime game last night. So back at it here this morning and getting the market outlook. What a crazy end to the week. Maybe a little bit of a buzzer beater for the S&P 500. We'll see how we play out. So I really break down what we should expect or what we can expect to see heading into next week and then beyond, and what the technicals are suggesting, and with some rare technical signs that we haven't ever seen in a long time. So we'll break those down with a trade idea in a sector that has been relatively strong but it's been showing weakness and how we can take advantage of that. So let's go ahead and get started. Today is Friday, December the 14th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. As you notice, we closed the week at the low. This is not, in fact, we've closed the last few weeks here close to the lows. You can see here last week we closed at the low of the week. The week of Thanksgiving, we closed at the low of the week. Now, the week after that, we closed at the high of the week. So it's not every single week, but we have closed three of the last 4 weeks at the low of the week. The last two times producing at least this week, at least a temporary increase with that long lower shadow on Monday. And you also notice, too, that we're filling in the range as of right now of that long lower shadow. We have dipped a little bit below that low point here, 2603. I think it's fascinating that we closed at 2599.95, as there are so many people looking at 2600 as an important support level. I hope there aren't too many people that would view a 0.05 of a point drop as a break of support, especially when we're still inside the range. It's the low point of that range that will act as a support on that hammer pattern. Of course, there's also strong support in this area from these lows from back at the beginning of the year. So that's where we're at. We're at we had a bearish posture. Again, the near-term line, even with the decline, still has not dropped into the reversal zone, and actually would still be higher. The near-term line would be higher than the last near-term low point, which had down here, which produced that low point. So, again, another bullish divergence setting up, similar again to this bullish divergence that you had that culminated in the low closing Friday at the low of the week there. So that's how that bullish divergence culminated, or at least that's how the week culminated with a potential divergence, and that's how we came out of that. And whether we get that kind of move again here remains to be seen. But it's not like we haven't seen this type of pattern before. So obviously, we're below a falling moving average. That's why it's red. The intermediate line is below 50. That's why we're dark pink on the shading. The momentum line is down, but not to an extreme low point either. So we don't, we have bearish short-term sentiment, but we don't have, we have falling short-term sentiment. We don't have like bearish short-term sentiment, which would have obviously the red line to an extreme low, or the blue line itself falling into oversold territory like we did over here for that matter, and we're not seeing that here. Now, this was a bearish near-term high point. We are going to a lower near-term low, but not on the indicator itself. So we'll see how we respond. The expectation of a divergence like that would be for a move to the upside, right? The near-term line says that we should be up in here right now, and we had more of a drop today than what the near-term line says we should have had. So that's kind of how we're seeing that. If you take a look at the Dow Jones Industrial Average, you can see a very similar pattern. Again, the near-term line not even close, but already to a higher low on the near-term line, or potentially setting up for a higher low point. The NASDAQ Composite, same thing, again, filling in the range from Monday, but not below it yet, and also not in the oversold territory either. And the Russell's the one that's been a lot more bearish. It did drop below the low that we had earlier in the week. And we have produced another oversold cluster. So you see another green dot. Again, the last green dot we had was November the 24th, but that was the 7th green dot. And again, to get a cluster of clusters like that, we haven't had a cluster of clusters that concentrated on the Russell since March of 2009. So this kind of shows how oversold small cap stocks are. We talk about the S&P being in correction mode, being down 10%. Well, the Russell 2000 is down 19%. So it technically is almost in quote-unquote bear market mode on its market forecast. And of course, strong bearish posture with the intermediate line down below, but down below 20. The market sentiment line. See, that's the difference between this cluster and all of these, is you have the market sentiment line below 22. So that's, again, very, very rare to get that type of a cluster. Again, to show you all the other clusters that we've gotten on the Russell 2000. Whoops. Here, let me zoom in, and you can see it here. And now as I move this over, here's some more clusters. Again, no market sentiment low point. That was 2017, August 2017. Here's the end of 2016. No market sentiment low point here. Here is 2016. At the very beginning, where we got the clusters, we didn't have. That's about as low as market sentiment has been. It wasn't in the reversal zone, but it was pretty darn close. And there's 2015, similar pattern there. Kind of that double. There's some more there. We didn't have market sentiment as low. Same thing here. No markets. This was 2014. No market sentiment there either, or here in April. Keep on going through. Here's some more. Again, this would be 2012. No market sentiment line down there. Here is May of 2012, when things were really bad. Again, we got pretty darn close there. And then, of course, some more. This would be our last time. October 2011. October 3rd, 2011 was the last time that we had an oversold cluster on the Russell 2000 with market sentiment. And just to zoom out here, so that's October the 3rd, right? To kind of give you of 2011, to give you an idea of what happened after that. October 3rd, 2011. I gotta go back further. So it'll be right here, right here. Let me zoom in. Zoom in a little bit more. So this will be 2010. So right there. So that low point right there, the low of that candle, was the last time, or excuse me, that's SPY. Let's go back to IWM and zoom in a couple times. So it'd be back 2011 here. The low of that candle was the last time that the Russell formed an oversold cluster on all four lines together. And you can see from that point going forward what happened, right? It's, from that low point, oops, touchy mouse, from that low point all the way up eventually till we peaked in, what would this be, 2014. That led into the weakness for that year, that the moderation, the peak momentum, the peak long-term momentum. We had 100% return off of that low, which ended up being a 41% annualized return over 2+ years, 882 days. So 41% a year for 2+ years, coming off of the last oversold cluster that we had, with the market sentiment line also being below 20, like we have right now. So whether that ends up being the case again, remains to be seen, and probably doubtful that we'll get that big of a bounce. But again, it's not like we haven't seen, this before, this kind of a pattern before. And, and again, markets tend to be more bullish when the bearish voices are the loudest. As you saw, in October there, I venture to guess bearish voices were very, very loud, similar to what you got now. And then, 2 years later, with 40+% returns a year, bearish voices aren't so loud anymore. So we've seen this kind of pattern before, and we'll see if history rhymes this time. All right, before we look at some other charts, a reminder to subscribe to our YouTube channel by mousing over this logo right here in the bottom right corner of your video. Click that red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells me that you like the video, you got something out of it, and it tells me to do the video again on Monday and Tuesday and Wednesday. Every time you click that thumbs up, that's the message to us that you want us to keep going with these. So again, if you don't want us to keep going, then you don't have to click on anything, of course. That's the message we take. Also, too, subscribe to our Daily Market Outlook email list. There's a link popping out in the top right corner of your screen. If you click that link, it will take you to a page where you can subscribe to it. On Friday's emails, you get 4 watch lists, right? You get the overbought and oversold clusters within the S&P 500. On the daily chart, there's over 100 in the S&P this week, or today on Friday. You also get the oversold and overbought weekly clusters, which not as much on the overbought, but there are some weekly, quite a few actually, weekly oversold clusters. So make sure you subscribe to that list to get those stocks. Also, too, follow me on Twitter for more content like this that I post out throughout the day, and kind of keep the conversation going between videos. And then join our Market Outlook community that we created on Facebook. If you're watching our video on our blog, you can subscribe to that email list a couple of ways. Down here at the bottom, you can sign up right here for the Daily Market Outlook email list right below the video. Just fill in that first name, last name, email address, click that button. You can also subscribe to our site. When you subscribe to our site, you also subscribe to our email list. You can do that by clicking on this icon. Subscribing to the site's free, and you can participate in our Market Outlook forums with this link right above with other market scholars within our community. Remember, again, clicking the thumbs up, you can do that here too. Click this heart on tonight's Market Outlook tweet. Click on this image. It'll take you to your Facebook page where you can thumbs up there, and then of course you can like it here on our blog. The more we see those likes, like I said, the more we are able and to do these videos day after day for you, for the broad community out there. All right, now we look at the long-term chart. You can see we closed below the low point of that long lower shadow I mentioned before, 2603. We're at 25.99, so it's a smidgen below. We're still in this area. We also closed below last week's low point, so low, high, lower, low. A smaller range than what we had last week, and an important week next week with all that we have on the calendar next week. An important week that all these other times that we've broken below the 200-day moving average, even on the intraday basis, we've immediately gotten back up above it. And it maybe took 2 weeks to do it, but you can kind of see how you can get right back up above it pretty quick. So if we were going to get back up above it with 2 weeks, that would be next week. So we'll see if that ends up being the case here. Because if we don't, then at the best, right, then we can just meander below for multiple weeks below the 200-day moving average, like we did both in the end of 2015-16. Now, they didn't lead to bear markets, as bearish as we were those times, and the long lower shadows that we did have then too, that held for support on a closing basis. But we did stay below for it took a while before we got up. It really didn't start till October 15 to get that move, and then this move started in February that we finally got the rally back up above. So it took a few weeks of sitting down here, and that will be the case if we don't get back up above the 200-day moving average like we've done all these other times that we've closed below it. You can see what it looks like in the S&P, the Dow Jones, not as far below. We don't have the death cross yet. The NASDAQ Composite got a big inverted hammer pattern, so it's not as bullish as a long lower shadow. Long upper shadows are bullish too when you're at the end of a downturn. They're bearish when you're at the end of an upturn. You just don't get very long upper shadows up here because the volatility is very low. But you can get them down here. Those are what are called inverted head and shoulders patterns. They're just not as bullish as the hammers. Inverted hammers, excuse me. They're not as bullish as hammer patterns are, long lower shadows. So, and then of course the Russell 2000 is the most bearish out of all of them, as I mentioned, down 20%. And to kind of show you again, the last time we had that cluster was October the 3rd, 2011, was it? And that's what it looked like right there. We were at the end of that kind of a run below the 200-day moving average. That October the 3rd actually ended up being, because it was the beginning of the week, ended up being the end of a long lower shadow. This one could be the end of that low point, so we'll see if that ends up playing out again this go around. Remember the last other times that we were close to clusters was here in 2015 and here in 2016. That we had clusters with market sentiment just a smidgen above 20. So you can see how rare that pattern is, number one, and number two, the reaction to the markets after we get that pattern. Of course, we got three red arrows here, so we got the red shading here as well. We got 1, 2, 3. If you look at it, break it out, those lines out into the two-line versions, you can see the MACD still hasn't formed a lower low point yet, even with this decline, even with the drop now to a much lower low. So big divergence forming on the stochastics and the MACD. You can see the stochastics rounding out, similar to the intermediate line, with the potential of crossing up above its moving average if we were to get back up to the 8-day. If I were to change that MACD and look at it, compare price to where we are to the 8-day moving average, 8-day exponential moving average, then you can see again a divergence that we're forming right now, and how low we are relative. Can change that number here to the 30-day simple moving average. So we'll just keep it as a 30. Well, here, let's change it to the 30-day simple moving average here. And again, you can see we're a little bit further below it than we were on this mark. So, and not the same kind of divergence that we have there. And again, as bearish as we're here, this level was the same distance, relatively speaking, below the 30 days that we were on this move, right? We had the initial surge, similar to the initial surge here. Then we had the bounce and then another bout of volatility. Here's our bounce and then another bout of volatility, getting to about the same level now as we were over here on the MACD, as well as actually on the price itself. Now let's look at the intraday chart, and you can see we didn't increase the range. The range is still going to be 280 to 258 for about another week or two, because we're right here in the middle. So it's going to take some time for that 280 to come off, and even more time for the 258 to come off. But still, you got about a 22-point range. You're close to 10% range on this. And remember, over 10% is really extreme. So the fact that we're close to 10% is pretty extreme too. And again, a reminder of that linear regression. We are again closing outside that third standard deviation channel. This is the second one. The purple line is 100%. So it's right there at the third standard deviation channel that we're closing out. Closing this today or Friday. If you take a look here, go back to the chart, you can see the gradual decline from 269 that we've had down to 260 over the past few days. Still holding that low point there from Monday, from earlier this week, at the very, very beginning of the week. Obviously, we're in the lower half of the trading range. We did get a lower high and a lower low. We closed at the low. We closed below last week's low point. Right? This isn't last week's low point. This is this week's low point. So we're going to end up with a lower high, which is on Wednesday, and a lower low. So the high of the week is, for the first time in a while, is going to get below the 4-week midpoint. So again, kind of reflection of the bearish short-term sentiment that we've had. If you take a look now at the volume and the trading range today, let's go to the 3 green arrows chart. Pull up SPY here. Remember, there's a gap here, so we closed 265.37, the high at 264, so about a point and a quarter. So you add that to the range here, so you're about at 5.5 points, so a little bit above average on the range. The volume was also a little bit above average too. The average at 115 million plus. We got to 117 million. So when you put that in context here, the average is up here, and on the ATR, the average volume is right in the middle. Again, the trading range, the ATRs are not getting above 2% yet. 2%, we were at 2% today with 5 point, over that 5 point range, a little bit over 2%. But we're not getting those strong numbers. Remember, this average has to get up to 2.5 to 3% for us to consider this the beginnings of a bear market, where you get the bounce up and the failed return move to the 200, and then we roll over like we did in the beginning of 08. That really turned into the bear market after we peaked at the end of 07. So we're not getting that yet. We're getting a very similar move, as I mentioned, to what we saw over here. And remember, these lines start dropping before we bounce. From the time that these peaked right here, by the time the intermediate run started, that was the length of time that we had before the intermediate run started. That started the long-term, the multiple intermediate rally long-term run that we had over the course of most of the summer, late spring and summer of this year. Now let's take a look at the volatility index. And interestingly enough, this was one of the rare weeks that we had the S&P go down more than 1%, and the volatility index went down this week too, because we started off way up here around 24. Actually, we started off about 23, just under 24. But we started off really high and got really high early, and then despite the drop from last week, volatility actually stayed down. With today's move, we only went up to 22. In fact, we didn't even get above 1 on the VIX to VXV, or VIX to the 3-month ratio. So that kind of goes to show again that markets aren't too concerned about a break below 200 because they're not buying the protection on the short term here to the same tune as they were buying even late last week. We were a lot more. The VIX was a lot higher than it was and what we're seeing now, and we're getting that divergence now. In fact, if you were to take a look at the trends on the short term for volatility, considering this is our last peak, we're coming up off of a lower low point. We got up to a higher high in volatility from one high here to the next one, kind of a double top up here, and at the present we formed a slightly lower low on volatility, slightly is a key word there, and now we could be forming a much lower high point. Which again, the downward trend for volatility would be bullish for equities. So kind of interesting to see that pattern developing on the typical volatility moderation pattern that we see on the VIX. So again, to summarize the market outlook, obviously we have a bearish posture and bearish short-term sentiment, but not as bearish as you would have expected when you're closing at a significant support level at the low of the week. With a lot of bearish noise that's out there. The bearish voices get louder and louder. So we would expect to be a lot more bearish in the short term from a technical perspective than what we're seeing. So that might lead, especially with the oversold clusters the rare oversold cluster you see on the Russell 2000, that might lead to a potential week next week where we might get some bullishness. And a hold of support. Now, that doesn't mean that we might not get a long lower shadow and a break of that 2600 early next week. We could very well do that because everybody's been watching the same level, and it can bring in a lot of bears once now that we've closed 0.05 of a point below. That might be what produces another potential long lower shadow on the weekly chart before finishing this week, before the Christmas holidays, early next week. On the upside. So we'll see if that ends up being the case. What do you think? Do you agree or disagree with that? If you there's a poll popping out in the top right corner. I'm interested now to see what you think because again, I like to look at sentiment surveys and I'm more of a contrarian from that standpoint. So I'm interested to see how many people do disagree with that because I'm interested to see if we do get a significant jump than what we've had in the past because I will definitely be looking at that potentially as a technical indicator itself. So vote. I want to see your opinions and your thoughts and what you expect the market to do with what you think about my market outlook from going through this posture routine. Again, if you click disagree, I'd love to hear your thoughts down at the bottom. Comment on anything that what you're seeing. Comment on anything again that stood out to you from tonight's video down there. All right, let's take a look now what's driving the price action here. And you can see early on in the week when things were bullish, emerging markets really led this increase up to the upside. The S&P, small cap stocks, international developed stocks all rallying. High yield bonds were up. Crude oil was never able to. And again, I mentioned before, crude oil doesn't get a lot of attention for its role in this decline. But really, when the markets fell off at the end of the week here, we were getting some declines here when we got the initial drop in crude oil. A little bit of a bounce in crude oil. And then you can see how we finished the week. That led to a lot of this risk off. In fact, by the end of the week, the dollar was your best performing asset class But you notice that high yield bonds didn't fall. So that's another sign that a lot of people are taking, again, how bearish we were, that high yields were not as bearish. They should have fallen a little bit more. Long-term bonds also were relatively flat, so it wasn't really a flight to safety. Gold ended up being down because of the strength in the dollar. So if you take a look at how these same asset classes have performed since October the 3rd, when the stock market peaked, so we'll go to a daily chart here. You can see crude oil is down 30% in that time. So again, there's initially it kind of fell along with all these equities, but since then, equities have been kind of flat to a little down. Emerging markets are actually up off of that low point on October 29th. We're down a little bit below. Small cap stocks are obviously to a lower low. Developed markets are down a little bit too, along with the S&P, but emerging markets are actually higher. If you look at preferred stocks, they're down from that level. If you look at, this would be long-term bonds, they're up from that point, and high yields down a little bit too. Gold and the dollar are relatively flat, with agricultural commodities holding up. So, you would expect if tariffs, trade war were still a bigger issue, then the agricultural commodities would be down more. In fact, if you were to go back, over the past year, agricultural commodities had really been on a decline, really since what would be May, we'd be right about in this area here, May the 25th. Let's go back to that time frame here and do a custom time frame back to May the 25th. When things really started to get heated, there's your agricultural commodities. They were down quite a bit, and emerging markets struggling too. Crude oil coming down. What wasn't down so much, right? It was actually doing a lot better. But that was trade war. This is trade war related. And the S&P was actually able to hold up relatively flat from that time. In fact, they gained through most of this time. When emerging markets and agricultural commodities were down, the S&P gained. Interestingly enough, since agricultural commodities have bottomed out, DBA, that's when the S&P started to falter, interestingly. And you can see emerging markets also faltered a little bit, but they've kind of based, whereas U.S. stocks haven't. And you see the dollar with these commodities have actually gradually started to move their way up higher, and the long-term bonds, which were negative during this initial drop, have also recovered during this time frame. Okay, now we look at the foreign stock markets and how they performed this week. Not everything was down. Most things were down. There's emerging markets. AGG, which is kind of a combined U.S. income, was relatively flat. And there's everything that outperformed. Look at China, was actually up on the week along with India. A nice little bounce it had, even with a drop early on in the week. There's ACWI, which is got a heavy component of U.S. U.S. stocks was one of the worst performers on the week. Turkey, Argentina, down at the bottom, the only ones underperforming small cap stocks. You can see even Russia outperformed our small cap stocks. Canada, Australia, Japan, all similar declines in what you see in the S&P. Developed markets, France, Germany, developed markets in Europe at least. France, Germany, there's Italy. They actually had a pretty decent week, relatively speaking. They've been underperformers, but they're holding some lows. So kind of a good sign from a weekly perspective to see there's some more Sweden and Spain up there. So you can kind of see there are especially these Asian emerging markets that had a decent week, and European markets kind of holding, setting up a low point. Kind of gives you a good sign that, remember, that the U.S. stock markets will most likely follow these international markets as they get going again, as we saw in early 2016. So we'll see if that ends up being the case again this go around. Okay, now let's take a look at how the sector rotation is playing out. Now you notice the sector selector tool, this proprietary tool that Brandon's created, has been published on the blog here. So again, it's at the very top of our blog, so make sure you check that out. Market Scholars, if you click on it, you can be able to see the details of individual stocks within there's a second image that he's created. Of course, and everybody can see at least this part. And you see that the rankings have been upgraded, and you'll see that here in just a second. This is this week so far, and how it's performed. You can see not again your typical risk-off week. I mean, the S&P was down 1.25%. Your biggest losers were energy and financials. Again, energy really struggling, financial struggling with a little bit of a rise in the yield curve, with the progressively declining yield spread. Even though it bounced up here most recently, you can see the other biggest losers: healthcare. That's not something you expect to see to the downside. Real estate, staples outperforming, but with a small loss, and utilities actually with a gain. Look at this for the week too. Technology was flat, and communication services finished up. So again, not exactly your most risk-off week. A week where we finished the week at the at a low point, and we had gains in some of these quote-unquote risk-on sectors. So for our trade idea of the day, I do want to look at one of the stocks that's in that healthcare sector. It didn't have a good week and hasn't been doing as well lately, falling down in that sector selector rankings. You can see it's AbbVie as a stock. You can see the pull. We got 3 red arrows today, moving, trying to get this new bullish trend going. Not looking so good, right? A little bit of a head and shoulders pattern developing over the last few weeks. If you take a look at this market forecast, also, it's been trying to get going here, but now we'll have a yellow moving average since we're below it tomorrow, and moving average heading lower. Light pink now could turn to dark pink here soon, similar to what we saw over here. Some bearishness showing up. You look at the Bollinger Bands for AbbVie, and you can see that we hit a lot of resistance up in this volume area and not very much support to the downside. So there's some room for this to come down. You also take a look at the 3 green arrow chart here for AbbVie. Here we go. You can see breaking back below the 30-day moving average, the 8 and 17-day coming down, and also close to crossing back below. MACD turning negative, both MACD and stochastics below their moving averages. And you can also see too trading in the lower end of its 4-week range, retesting of this low point. So there's that inverted head and shoulders pattern with some support down in here. So you can say, okay, well, if I were to sell this 87.5 put, which would be right in this area right there, and then obviously we're getting a lot more credit than we need. So let's say it's a little bit wide of a spread. So let's say that we don't get into this until it breaks down to 65. That means it's got to break down to 84 before we fill in, roughly, theoretically speaking. So it would require a breakdown for us to get filled into that trade. Just to kind of make sure that we get the bearish move that we expect. And then we still end up, even with waiting, we still end up getting enough return to justify the risk of getting into that trade. Because again, it would have to get all the way back up. And if you were to analyze this trade, and we'll do this single symbol here, and then go to January, you can see if we were to analyze this trade here, set a slice to break even, we have pretty decent odds. And if I were to set that slice on this chart, that's where it'd have to, after breaking to 84 through these lows, we'd have to get back up above and get into this area before we even start to take a loss. And for us to then say, okay, well, I'm going to take and I'm willing to take up to a $65 loss, then we're looking at right about there. Set that slice to the chart, and there's the point that I would get out. So we'd have to kind of get back up above this 88 area into this closer to 89. So basically nullify the breakdown for me to end up taking what would be a small loss in the trade. Alright, so that wraps us up for today. Now it's your turn to share your thoughts with the Market Scholars community. There's that link that popped out there in the top right corner. Click that link to go to the forums. Remember, you have to subscribe to our site to participate, but I'd love to hear your thoughts on what's going on here in the markets lately. Remember, or any questions or comments you have about what I talked about, or any questions or comments about something I didn't talk about that you wanted my take on, make sure you put that there, or anybody else's in our community take on that subject. So make sure you post in our forums. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, click that thumbs up icon, and comment. Also follow us on Twitter and Facebook. Join our community on Facebook. And as always, thank you again. Have a great rest of your weekend, everybody, and we'll see you all next time.